Hello, good afternoon, everybody. Thank you so much for spending your afternoon with us, especially if it's sunny where you are, like it is where I am, to learn a little bit more about financial planning and becoming financially secure. So just before we start, I'm wondering if you would please fill out our short survey via Slido. And whether you are somebody who identifies as someone who likes to keep up with the markets and keep up with what's going on in the financial world, or if you're someone who just buries their head in the sand and prefers not to look at their bank balance, or somewhere in between, we hope that you will gain some insights from our session this afternoon and have a takeaway that you can action afterwards. So if you could just fill out the Slido, so you can either join at slido.com and use the code 1079495, or if you're a little bit more tech savvy, which I'm assuming you probably are, you can also use the QR code. Brilliant. I can see some people are already on there. That's great. I'll just give you a little moment to fill those out before we begin. If you've just joined us, as I can see, there's a few people still joining us. If you would just fill out our survey via Slido, you can do so on the link slido.com and add the number, or you can use the QR code as well. Are we good to move to the next question, Priyanshu? Thank you. I promise there's just 3 questions, so we will move on. It won't be the whole hour. And we'll just move on to the final question. Okay, I think that's as many people as we can get using the Slido. Thank you so much for filling that out. And let's kick things off. So you'll be led through the session today by myself, Catherine Reese, Ben Hayward, and Emma Thomson. Ben and I work at Jackson Hodge Wealth. My background at Jackson Hodge is in the client experience side of things and business development. I've worked for many years in financial services, and I've worked with startups as well on a freelance basis. My background is actually in theatre, and I also coach communication and public speaking, and I'm a trained actress as well. So I have a wide set of skills. I always say I sound a bit like Liam Neeson in Taken when I say that, but I do have a wide set of skills, and we'll be applying these to today and hopefully sharing some of those as well. And I'd also like to introduce Ben Hayward, who is our lead financial advisor at Jackson Hodge Wealth, and he'll be taking us into a more deep dive of all the financial nitty-gritties that you can action as well as part of your goals. He's a fully qualified wealth advisor, and his background is also as a leading insurance broker and has served in the military. So he's also got a wide range of skills that we will be drawing on today, although hopefully not too many anything particularly military in terms of anything aggressive, but who knows? You just never know. So yeah, he's our lead advisor and will be open for questions at the end as well. Emma Thomson is the chair of the Women in Protection Network. She has a really fascinating story to tell, and so I do hope you will stay with us to tune in with that. And also she's got a wide range of expertise in terms of insurances and protections as well. So you will definitely get some actionable tips from Emma in this session. So let's get started with the definition of what FIRE means, which is the acronym Financial Independence and Retire Early. And you may have been drawn into coming to this session because of that. However, this acronym means different things to different people. So for us and for the purposes of this webinar, it means that we want to assist you in creating financial security for yourself and positive financial habits. We want to provide you with valuable information that can then assist you in creating that financial plan and even just getting more clear on what your financial goals are. We'll also be providing you with insights that will align with what you hope to be your financial goals in the future and what you hope for yourself and for your family in the future. So to be clear, we're not here to rush you into retirement. We're here to support you and answer any questions. And financial independence means essentially having enough savings and investments to cover your living expenses at the most basic level. It involves building a robust financial cushion that then allows you to live comfortably. Retiring early is something that's pretty clear and obvious, but actually the goal of leaving the workforce before the conventional age of 65, which is around about when people retire in the UK, although this may be on the rise. And also, it doesn't necessarily mean that you're going to have this cliff edge retirement and that you're going to stop work and you're going to get your clock or whatever it is that a lot of companies give at the end of your tenure. It means that you can spend your time maybe starting your own business, you can be freelance, you can also pursue your own passions, you can start something new, and you can travel or do whatever it is that you want to do in your retirement. Maybe it's spending more time with your family as well. And we want to help you support you to do that. So I'm also going to talk a little bit about the challenges that are unique to women and financial planning. A lot of you will probably resonate with one or all of these, and I'll just go through a little bit about each one. So financial inequality and the gender pay gap is something that you'll have heard for years now. Financial inequality often results in women having less wealth accumulation compared to men. And this is influenced by various factors, including overall lower lifetime earnings and differences in investment behaviors, which we'll be exploring a little bit more later on. This then has an impact on women's retirement savings. So women will end up with lower retirement savings. They will be earning less over their lifetime and having fewer opportunities for those high income roles. This will then affect their ability to retire comfortably, and therefore it may require a more aggressive savings strategy and a more tailored help with investing and education around investment strategies as well in order to alleviate that. With the gender pay gap, at the moment, a statistic from Action Aid is that 15.5% is the gender pay gap percentage in the UK currently. So men are earning that bit more. Women, it is known that women typically earn less than men for the same roles or equivalent work. And something that's come up for me in a lot of the coaching clients that I have in terms of public speaking is around negotiation skills. Women tend to need to focus on those skills in order to secure better benefits and higher salaries in the workplace. Women also tend to undermine themselves when asking for those pay rises, for example, or even just asking for general benefits in terms of what's offered to them. There's also more hesitation around celebrating and vocalizing their achievements in the workplace because they are conditioned, or we are conditioned, to not rock the boat and just get on with it mostly. So women, it's a constant learning experience for women to be able to carry themselves in the workplace and actually ask for what they want, ask questions, and and celebrate and be vocal when they need to be as well. And that can also then have an impact on the amount of earnings that you will then accumulate. Also, career interruptions and caring responsibilities as well is another reason for those earning gaps. So caregiving, women are most likely to be the people who will take on those caregiving responsibilities, which will then impact long-term savings and retirement savings. And this is also an impact on a woman, not only professionally and financially, but also that overall mental load. When you're carrying so much and your overall well-being is affected, you're not really going to want to look at your finances. And also these career breaks and interruptions limit career progression. Time away from the workforce means skill degradation, a loss of confidence, and then it makes it that more challenging to return to work and get that same level of compensation. Also, it's no secret that the cost of childcare and elder care is high. This often makes full-time employment less viable, and so people have to make that decision to go part-time or to handle that in the best way they can. As a result, more women are then likely to experience economic security and face those challenges in balancing work and having those caregiving duties and career breaks and everything else we're juggling. Also, women in terms of life expectancy, men at the moment are around, their life expectancy is around 78.6 years old. Women's is 82.6 years old. And women will then have that longer life expectancy and will need provisions to accommodate that. Also, risk aversion. So women are typically more risk averse in life and also in financial planning. If women are not approaching risk in a certain way when it comes to their financial planning, their portfolio will then not grow to meet their goals. And that's when they need that extra help in order to strategically build their wealth and stay informed and work towards that long-term financial stability and independence. And you can see here a few different key facts and considerations just to back up and underline what I've just been talking about. And I'm sure, let me know as well in that chat as well if you relate to one or all of those aspects in life or the workplace. So to go into a little bit more detail about that financial planning aspect, I will hand over to Ben, who will be, as I mentioned earlier, open to questions as well.
Thank you very much, Catherine. And good afternoon, everybody. Thank you very much for joining us. So what I wanted to run through today was some of what I think are the important factors to consider when thinking about financial planning. The first thing to do to kick off with is having a look at some of the key considerations that you should be taking into account when putting together a financial plan, whether that's doing it using an advisor or if you're going to be doing it by yourself. These aren't set out in any particular order, and I'm not going to run through everything in huge amounts of detail. You can see the stuff on the screen, and most of it is fairly self-explanatory. But to give an overview, obviously, one of the most important things is to make sure that you have good, solid objectives and making sure that you have goals for the short, medium, and long term, and taking into account the fact that obviously life is going to change in ways that you can't necessarily anticipate at the outset. So it's having the flexibility within those goals to ensure that they can remain achievable throughout your lifetime. And for me, that is one of the most important attributes that a financial planner can bring to the table, is the ability to sit down and think with you about those goals and making sure that as you go through life and your situation changes, whether that's for the positive or negative, that you are able to adapt those plans, goals, and objectives to ensure that they remain relevant to you. Some of the other points to take out from this, obviously, is looking at protection, which Emma's going to cover, obviously, in much more detail later on. But certainly, from my perspective, it is absolutely paramount that you have the right foundations for your financial plan in place, because if you don't, essentially you're building a plan on a house of cards that could all come crashing down when life will, as it so often does, throws a curveball at you. So having all of that solid structure in place and the protection around it is vastly key. The last point is looking around the investment strategies, and this sort of plays in a bit to what Catherine was talking about previously with regards to the tendency, and I'm certainly not wanting to generalize, but following on from Catherine's point about women taking less risk, as we'll demonstrate later on, the difference in taking different amounts of risk over time will have a huge difference on the ultimate outcome of your investments. So it's really worth making sure that you understand what the risk is and planning accordingly. So what I wanted to illustrate here was looking at a typical scenario and the things that I take into account when putting together a financial plan for a client. Now, obviously, plans are all different. They very much depend on people's circumstances, their goals, their dreams, and all of that. But there are some fundamental building blocks that are useful to have in place and to understand in order to ensure the success of any plan. And we try to use the analogy of having a cup and the things that you can put into that cup to fill it up to the top to make sure that your plan is successful. The most important part is making sure that before you start any of the planning, that you've got all of your house in order in terms of managing any debts and having provisions in place for stuff that life could throw you. So that for me is looking at having an emergency fund, which is essentially a cash pot that's put to one side and almost forgotten about, that gives you a certain amount of cover for about 3 to 6 months worth of expenditure, so that you know that whatever happens in life, if you get made redundant, if something happens and you're unable to work, you know that you've got something to cushion the blow for those first few months, which can be critical because it means that you can then focus on the other things that are important in terms of getting yourself back up on your feet. So that's really important. What you then do after that obviously will very much depend on your circumstances, your ability to do it, and what you want to achieve out of it. But there are some fundamental financial planning tools that we would use in order to help you realize those dreams. And each one of them will be geared towards different types of goals and different lengths of savings. So if we're looking at short to medium term, we'll be talking about things like ISAs, individual savings accounts, or junior ISAs if you have children. And then for the more medium to long term, we look at things like general investment accounts, which are another form of investing, but they don't have the tax efficiencies of an ISA. And we'll cover that off in a minute. And then obviously longer term, looking at pensions, which for most people will be the engine that drives their income in retirement. So once you've established what your needs are, you can work out where you can allocate the funds in order to get the most tax efficiency and generate the most investment growth to help you realize the plan. And again, this is where having the financial advisor, the planner sat there with you really helps and adds value, I would hope, so that you can turbocharge those goals going forwards. And then sat around the outside of that, as I mentioned before, is having that protection that Emma's going to talk about in place. Because, as I said, if you think of this cup as a glass cup, whilst it can protect the stuff that's inside it pretty well, if something comes out of left field, knocks that glass over, everything inside it's going to pour out and the glass is going to smash. So in order to make sure that that doesn't happen, it's really important to have a think about the protections that you can have in place to help ensure that your plans don't get derailed. Okay, so having a think about ISAs, I'm sure everybody's heard of ISAs, and I'm sure you know a great deal about them. I won't go into too much on the technical side of things. There are a huge different array of ISAs. I'm going to cover off two of the main types that most people would have heard of, that being a cash ISA and a stocks and shares ISA. The fundamental difference between the two of those being that a cash ISA, as it says on the tin, is your investments are held in cash, and a stocks and shares ISA allows it to be invested in various different asset classes, whether that's, as it says, stocks and shares, or it can be invested in other asset classes like bonds, or a bit of cash, or property, or various other things that are not necessarily that relevant for the composition is not that relevant for what we're trying to discuss here. And so what we're trying to show and demonstrate on this slide is the impact of the tax efficiencies of ISAs. So anything that you put into an ISA will grow tax-free, and you can then take anything out of that ISA tax-free as well. So if you build up a big enough pot, you can, in certain circumstances, live off a tax-free income from that ISA, which obviously means you end up drawing down less because you're not having to pay tax on top of it. Historically speaking, cash ISAs I've found to have been almost a waste of time because interest rates have been so low that there's no point having an investment that you get tax-free growth if there's no growth on it. But obviously, in recent years, interest rates have gone back up, and therefore they come back into prominence a bit more, mainly because of this security around what the growth rate is going to be, and so you can make better plans around that. However, so what we're trying to demonstrate on this slide is looking at the difference between if you had £100,000 invested over 10 years, sat in a savings account versus sat in a cash ISA versus sat in a stocks and shares ISA. And we're being very generous in these assumptions and looking at sort of current interest rates, although obviously those are likely to go down over the next few years. So as you can see, looking at this, even with a cash ISA trumps a deposit account, even with a smaller growth rate. And the reason for that is because you don't pay tax on any of the growth that is within that, whereas you would do on a deposit account. You're allowed to have £1,000 of savings interest each year. Anything on top of that will then be taxed, whereas anything that's held within an ISA will not be. So that's why even with a lower growth rate, you're seeing a smaller amount, a higher amount after tax. Obviously, with a stocks and shares ISA, what this is starting to show is the impact of compounding growth. So despite it only being 1.6% higher growth rate, coupled with the fact that it's tax-free income, you can see the impact that then has on the growth of that £100,000 over 10 years. You're getting an extra £37,000 purely because of the growth and the tax efficiency of that wrapper. So ISAs are a great tool to be used in the short and medium term because they are instantly accessible, tax-free growth, tax-free income out of it, and generally they are a staple of most plans for people in the short to medium term. So the second thing then to have a look at is the pensions. And here what we're trying to highlight is the advantage of a pension is that the idea behind it being that historically speaking, the average life expectancy was much lower. People would normally have worked in their careers in one job throughout their whole careers. They'd have got to 65 and they get a final salary pension, and most of them would sadly depart this world by the age of 75. So the pension would only have had to pay it out for about 10 years. Now, with life expectancy going up, it's very possible that people, especially women, are going to end up living well into their 80s, if not their 90s. And our children could well end up living into the hundreds. So it's perfectly possible that you spend up to a third of your life in retirement. And therefore, these final salary pensions couldn't keep up with that. And so the onus was put back on people to pay into their own pension schemes, where they get a lump sum, and then that then has to become the thing that drives their income in retirement. So the way that those operate is that anything that you pay into those pensions, the government will essentially repay the tax that you've paid on that income. So if you were to put £100 into a pension, you get the 20% basic rate of tax back. So £125 goes in. You then, if you're a higher rate taxpayer, get to claim the other £25 that you've paid in tax back on a self-assessment. So the marvel of a pension is that in essence, you're paying £75 in each month, but 125 is going in. So you're getting 60% growth for doing nothing. So if we look at how that impacts, this obviously only takes into account the 20% growth that gets put onto the contributions. The other stuff will be money that comes back into your pocket through the self-assessment. If we look at the difference between starting out at the beginning of your career in your 20s and looking at the difference that that 20% can make over the 20 years, what you can start to see is the real impact of that compounding growth, but also the impact of that 20% that is going in on these two graphs. And you can also therefore see the impact of the different amounts that you put in. One of the things that I would always do when I'm sitting down with a client is have a look at these differing amounts, work out what they want and what they think they might need in retirement, then having a look at what they can afford to do in retirement and trying to sort of marry the two up. But pensions are a fantastic way of being able to save over the long term for your retirement because of the advantages of the tax relief on the way in. On the way out, you get to take 25% tax-free. The rest of it will be taxed at whatever your marginal rate is. The other great thing about pensions is that they sit outside of your estate for inheritance tax purposes. I will caveat everything I'm saying today by the fact that Rachel Reeves may rip all of this up next month, and we'd have to have another chat about any decisions that are taken then. But certainly for the moment, it sits outside of your estate for inheritance tax purposes. So what that is, a great tool if you're in a position to do that, is that if you build up enough in your ISAs, you can actually draw an income from those, and you can pass on your pensions to your children, essentially tax-free. So that's why pensions are a fantastic vehicle for long-term savings. Okay, now wanting to have a think about investing itself and what you're investing in, and the risks of being overly cautious or worrying about timing the market. So my mantra when thinking about investing is that it is about time in the market, not timing the market. And as soon as you are able to start building a plan and start saving, you should do so. What this graph very dramatically demonstrates is the impact of missing out of the best days in the market over a 20-year period. And so, as you can see, over 20, you miss the top 60 days, your £10,000 would only be worth 4,200. But for me, the really striking number is right on the right-hand side here. So if you missed the best 10 days over the last 20 years, so if you think about that, it's 10 days out of 7,500, your investment would have halved in terms of the growth that you could have achieved. That is massive for such a small amount of time. And so again, it's another great reason for at least being educated to the fact that markets are volatile, they will go up and down, but a lot of the time it is just about sitting on your hands and doing nothing. I think as the great Winnie the Pooh once said, sometimes the best thing is to do nothing. And that is incredibly pertinent here, because you can see just getting spooked and coming out of the market at the wrong time can actually cost you very, very dearly. And so what we wanted to have a look at here is looking at some actual portfolios that we use and looking at the difference between them and the impact of compounding growth. Obviously, the main reason for doing this is looking at different risk profiles which again sort of comes back to what Catherine was saying earlier about the tendency for women to be a bit risk averse. Also, obviously, thinking about the longevity aspect of it and the fact that women will be living longer. So, therefore, it is even more important for them to be educated around risk and realize that risk is actually your friend. So, the way that risk is normally managed within the investment sector is primarily through volatility, but actually there are an awful lot of other risks that need to be taken into account. And volatility is essentially looking at how much the markets go up and down. And if you don't embrace the fact that there is volatility in the markets, and that volatility is your friend ultimately, as you is demonstrated by the graph underneath, which I'll explain in a second, then actually you will risk missing out on an awful lot. So if we look at the growth rates on the portfolios that are listed there, so the black line being the moderately cautious, which, you know, when I sit down with clients and go through a risk profile, the way the questions that we don't construct them, they are sort of mandated questions, the way that they're built, it preys on people's cautiousness and their fears around risk and losing stuff, and you could quite easily end up coming out as a moderately cautious, in inverted commas, investor. But the difference that you can see between that and the moderately adventurous, it's less than 2%, but that 2% compounded over 30 odd years that we're looking at here means you'll end up with half the amount of money that you would have done if you'd stayed invested in, or if you'd been invested in the more adventurous portfolio. And obviously that is, you know, I can't even begin to explain how fundamental an impact that is on the standard of living that you might be able to achieve just by virtue of the risk appetite that you've taken. What the graph underneath looks to demonstrate is the fact that although there is that volatility in the market, it's also very clear to see that the overall tendency is up. It's an upward trend. So what this is showing is the difference between what's called a bear and a bull market. So a bull market is where the markets will grow by more than 20% over a 2 to 3 month period or longer. And a bear market is where it falls by 20% or more over that kind of a period. So the green represents the bull markets and the orange represents the bear market. So looking at over that time scale, you can see that the growth within the markets is much longer and lasts much longer and is much higher the longer that you are invested. So, you know, my overriding message to people is always that the longer you are invested, the better your opportunity and your chances to achieve your goals. And I think that's borne out in the performance that you can see in those portfolios above. So the next thing I wanted to just have a quick think about is what retirement looks like. So what I always find when I'm speaking to clients is that one of the questions I'd always ask them is, how much do you think you'll need in retirement? When do you want to retire, and how much do you think you'll need? And you know, it's very rare that they'll have a concept of what that is. So for all of you, it's good to have an understanding of what that might actually look like. And these are figures that have been pulled off that give you an indication of what retirement might look like, or the income that you might need when thinking about how much you need to start putting away. And to put that into very basic terms, if you think that there is an old mantra that has sort of been a bit debunked now, that you probably want to be drawing about 4% from your investments in order to create a sustainable level of income. And you think that you've got probably around 9,000 to 10,000 coming from the state income. It means that you'll need your investments to be generating depending on where you sit within that, somewhere between 20 and 30,000 a year in order to have a moderate to comfortable lifestyle. So that does mean that you do need to take things seriously as early as you possibly can, because if you leave it too long, then it becomes all that more painful. And certainly from my point of view, the earlier that you can get started, the better, because what that then allows you to do is to allow your savings plan to grow as your income grows, rather than trying to reverse engineer it. And when you've got a lifestyle that you enjoy, having to cut back on stuff in order to start making provisions for things like this can become all the more troublesome and difficult. So the earlier that you can get started with this stuff, the better. So yeah, what I'm going to do now is pass over to Emma, who's now going to take you through some of the protection side of things.
Okay, can I just check how long we've got, please?
We've got about, I'd say about 15-20 minutes, but we can make the session last around an hour. So, and we need about 10 minutes for Q&A. So
that's fine. That's absolutely fine. Cool. Great stuff. Thank you.
Great.
Yeah, so I'm here to talk about protection insurance. We're all familiar with insurance, but not necessarily protection insurance, other than perhaps life insurance. So I don't know what you might have in place already. You might already have something. But I just wanted to highlight some of these statistics to really sort of showcase why you should consider insurance if you haven't actually already got some. So there's a number of stats there. I won't go through all of them, but I know from the Slido questions that some of you are self-employed, you've got your own businesses. So the one on the top right, the 59% of SMEs would cease training if they lost a key person. Now, what does that key person mean? That could be you as the leader of the business, or it could actually be other people within your organization that you really rely on. And if they weren't able to actually fulfill their duties, for example, if they were long-term ill, or for example, sadly, if they were to pass away, what would actually happen to your business? Because lots of business would massively struggle if that person was lost. Protection insurance can help you make sure that your business can still function. Then for those of you that have got children, I probably don't need to tell you how expensive they can be, but that bottom right one about the cost of raising a child. So if you're not too sure what type of cover you might need and how much cover you might need, that could be a good starter for 10 in terms of actually what the level of benefit that you might actually need to make sure that if for some reason something happened to you, there would be enough money to make sure that your children would still have the financial support that you would need them, you would want them to have if for some reason you weren't there. Savings, not enough of us save. I think we can all probably put our hand up and we'll all admit that we need to be saving a little bit more. But yeah, 3 in 10 Britons have literally saved nothing in the last 12 months. And, that research was undertaken in 2023, and obviously with the cost of living and mortgage increases, chances are that's probably going to be even more of a, it's probably could be 4 in 10 Britons, for example. And then the bottom left one, about 80% of residential mortgage holders don't have IP, and IP stands for income protection. And what that means is, how do you, if you were to lose your income through illness, what would happen? Well, income protection policies can actually make sure that that income is replaced should you be short-term or long-term incapacitated. It's a hugely important product, but it's a product that a lot of consumers don't actually know even exists, because actually you need to buy it through an advisor. Lots of people buy insurances through aggregators such as Money Supermarket or the Meerkats, but actually to access income protection, which is a hugely important policy, you should go and speak to an advisor. That for me is my most important policy that I want to talk about today. So I will be talking a little bit more in more detail, but certainly income protection, definitely the one to think about. So if we could get onto the next slide, please. This is, appreciate it's a bit tiny, but this one is a really important statistic as well. So Legal & General, massive insurers, I'm sure most of you are familiar with, do regular research in terms of actually how far away each household is away from the breadline. And sadly, the last report that they produced showed that it was only 19 days. Now, that does vary in terms of where you might live in the UK, but only 19 days away from the breadline. So if they lost an income or both their incomes, obviously, and some people are, you know, a sole householder like I am, you know, if you lost income, what would actually happen? There's just not enough financial resilience in the UK. And that's why, you know, we're holding webinars like this to try and help more of you actually understand what you can do to actually try and improve your financial resilience if something bad should happen. If we could get on to the next slide, please. Because bad stuff does happen. So I'm sitting here talking to you as an insurance professional, an expert, but I'm also sitting here talking to you as an everyday woman who's actually gone through this myself. So I'm not just here telling you that insurance is important because I'm trying to sell you something. One, I'm not selling anything, but most importantly, I'm trying to get across that it can be absolutely life-changing. So I was diagnosed with breast cancer 5 years ago. And I was lucky enough to work in this industry, so I knew exactly what insurances I needed to have in place. So first of all, I just want to highlight that bottom right image. So that is an image that's produced by an organization called Know Your Lemons. They're based in the US. And each of those lemons represents a change in a breast that could indicate breast cancer. We've all been told for years about the fact that we should be checking for lumps, but actually there are so many more indicators that could indicate that you might have breast cancer. And actually I was one of those people. I didn't have a lump. So that image, you know, potentially could have saved my life. So I went to see the GP, got referred to go and have the tests undertaken, and sadly that day I was taken into a room with sofas and cushions and told that I had cancer. And what was really interesting for me as a professional, it kind of helped me because obviously that was a massive shock to me at the time, as I'm sure you can imagine. But the breast care nurse, after talking to me with the specialist about what the next steps were going to be in terms of my medical treatment, the nurse actually said to me, "Emma, are you worried about money?" So I was sat on this sofa thinking, well, am I worried about money? And I was thankfully able to say back to her, no, I'm not worried about money. I wasn't worried about money because I had good sick pay from my employer. I had that income protection policy, which I'll talk a little bit more in a minute. I had a policy called critical illness insurance, which would specifically pay out for cancer. And I was also lucky enough to have private medical insurance. To be perfectly honest, given what I do, it would be very embarrassing if I didn't have those things in place, but I did. So I was able to say to her, I wasn't worried about money. That meant that I only had to focus on my health and my well-being. I didn't have to worry about how I was going to pay the bills. But it did make me think how many other people have been sitting on that sofa, not able to answer like I was, sitting there thinking, I have no idea. Is my partner going to be able to pay the bills? Do I have any savings? Oh my God, who's going to look after the children? Am I going to have to increase the childcare? How much is that going to cost? All of those things. And some of those people would have just gone, I'm screwed. I know I don't have anything in place, which, you know, massively upsetting at a time when you really just need to be focusing on the devastating news that you've just been told that you've got cancer or something else that's equally as serious when it comes to a health change. So, you know, so since having that diagnosis, I'm even more passionate about sharing my story and trying to get more people to actually think about insurances that could make a massive difference to them. You can get on to the next one. So yeah, so, you know, there are, you know, for those of you that are homeowners, you might have had a mortgage advisor that might have talked to you about insurance to go alongside your mortgage. You're taking out a massive debt. That mortgage advisor is doing everything possible to help you move into your dream home. But actually, that mortgage advisor should also be making sure that you can stay in that dream home should something happen, because there's lots of things that could actually impact you and your ability to be able to pay the mortgage back. And, you know, for most of us will have seen mortgage adverts, you know, your home is at risk if you do not keep up your repayments. But how are you going to keep up those repayments? Protection insurance enables you to actually do that should something happen. So the bottom right one, fire, storm and flood, we're all very familiar with home insurance. But actually what protection insurance does is enable you to actually have insurance in place so that if you get sick, if you become unemployed, if you have a critical illness like I did, or if you suffer an accident, or if sadly you pass away before retirement, before being able to pay off the mortgage, that your financial situation for you, your family, your loved ones, the people that you might leave behind, it is secure. And that's what a really positive difference that protection insurance can make. If you could move on to the next slide for me, please. So there are lots of different protection solutions available, which is why for me, absolutely go and see an advisor like Ben, because, you know, an advisor like Ben will be able to talk you through all the things that could actually be relevant to you and work out what's going to be suitable for you, your loved ones, and most importantly, your budget. You know, we've all got tight tight, finances at the moment. But the good news is that protection often costs far less than a lot of people think. So many research, has been conducted with consumers, and most people overestimate how much protection can be. So I can't give any prices to you because it really depends on your age, whether you smoke or not, how much cover you're looking for, what job you do, all of those things. But that's where an advisor is going to be so invaluable to you. Make sure that you speak to them, because ultimately, even if you walk away and decide, actually, I'm not going to buy anything, at least you've made an informed choice. You have taken that risk. Ben talked about risk earlier, so did Catherine. You've taken that risk to not buy anything, but at least you knew what the options were. But hopefully you will actually see the benefits of taking something out. And then obviously you can then decide what's going to be best for you. So there is personal insurance. That's the one that, you can literally just buy. I mean, you can go and buy it online if you want to, but as I said, go and speak to an advisor. And there's lots of different options to actually take out. So as I said, income protection, that effectively replaces your income if you were to be ill or to have an accident or another type of injury. It's not just physical health, it can also pay out for mental health as well. And you don't have to have a specific list of illnesses. It could literally just be anything that you are incapacitated for, you get signed off from work, and that insurance would actually pay out. Now, you can only insure a certain level of income, but it is tax-free. So whilst you might think, 65% of my income, that's not that great. But actually in practice, it ends up being more because it is actually tax-free income. You can also need to choose when you want that policy to kick in. So one of my key messages to you is, for those of you that are employed, do you actually know what you get from your employer? Because again, a lot of people don't know what they get, or they might overestimate what they get, or underestimate. Go and check it out. Go and speak to your HR team and find out what you've got, and then go and speak to an advisor about it. Because you can dovetail your cover to link in with your sick pay. So for example, if you get six months worth of sick pay, brilliant, count yourself lucky, because lots of people don't. But if you get 6 months, wonderful, you can then dovetail your income protection policy to kick in when your sick pay ends. And the longer that you can have that period, called a deferment period, the cheaper it will actually be. So if you have 12 months worth of sick pay, brilliant, you have a 12-month deferment period. You've only got 4 weeks, then you have a 4-week deferment period. But again, an advisor will be able to talk all those things through with you. And also think about when you want the policy to end. So, Catherine talked earlier about retirement ages. So you would normally take a policy until you're at your planned retirement age. But there are lots of different options. There are lots of different insurance companies available to you. So definitely find out what you get from an employer and then look at income protection. For those of you that aren't employed, then absolutely, income protection is really key for you, because you've got no safety net that anybody else is going to pay if you're not able to work. And income protection could be hugely, hugely beneficial for you. I talked a little bit about critical illness cover as well. So critical illness cover works slightly differently from income protection. So income protection will pay out a monthly benefit to you. As I said, it's replacing your income. Critical illness cover will typically pay out a lump sum for you if you are diagnosed with a specific set of serious illnesses. The 3 key areas that it will pay out on, the most common claims, are cancer, heart attack, and stroke, followed by multiple sclerosis. But actually, for a lot of insurers, the 4th biggest area of claims for critical illness is sadly children's critical illness, because yes, your children can actually be covered under your critical illness policy too. So for those of you that have got children that might already have a policy in place, dig it out, go and have a look to see actually what policy you've got, because actually in recent years the coverage for children has actually been improving. So if you have taken out a policy, say 5-6 years ago, it could be that actually you can get not only better cover for yourself, because the definitions for adults have improved as well, but also it could actually secure cover for your children too. And as much as you won't want to think about it, sadly, as I said, for some insurers it's the 4th biggest area of claims, because children do get sick. And as Catherine also touched on earlier, women are more likely to be the primary carer. So that money that gets paid out if your child sadly gets ill can actually make a massive difference to you as a parent, because it enables you to take time out of work. You can, as sadly, when it comes to child's health, if they're seriously ill, it's not just the same as when adults get ill. You can't just go down to your local surgery, your local hospital necessarily. You might have to go to a specialist care centre, and that could be absolutely miles away. That could mean that you might need hotel costs incurred, for example, travel, all of that. So, you know, that's where children's critical illness cover can make a massive difference to parents. I touched on as well, just, you know, about the 6 ways to lose your home, about unemployment cover too. There are a few insurers that will actually cover redundancy. During the pandemic, a lot of those insurers kind of moved out of the market because there were just too many people losing their jobs. But now there are some insurers coming back in. So if that's something that you're concerned about, again, you know, advisors can help you. But that's about protecting you and, you know, your personal, but, you know, there's business protection too. So those of you that own your own businesses, I touched on earlier about key person cover. Who's the key people within your business in addition to your own, yourself? But for those of you that perhaps own a business with somebody else, there's also shareholder protection. There's a case study if you are in that situation where you are owning a business for somebody else, you know, so other people own shares of your organization, then check out a case study for AMT coffee. So you might have seen AMT coffee in the train stations. AMT coffee case study is an absolute classic example of why shareholder cover is needed. Essentially, one of the brothers who owned AMT coffee passed away, and the other 2 brothers are trying to screw over his widow, you know, the person that's left behind, because there wasn't shareholder protection in place. So, and that's a massive court case. So the last thing you want is if something happens to your partner in business, and what's going to happen to the part of their business? Is it going to go to their children? Is it going to go to somebody else who has no idea what you're actually doing as an organization? Shareholder protection gives you and your business partner control over what happens should something happen to either of you. You also might want to consider IHT too. For those of you that have got, you know, a really big IHT bill, you can actually protect that. So, you know, again, that's something that Ben will be able to help you with. You know, lots of people won't actually be affected by IHT, but for those that do, and for those that might have a big bill left behind for their loved ones, IHT planning is part of a protection conversation too. That whole family protection, you know, for me, a lot of companies talk about protecting families, but actually you also need to protect yourself too. So when it comes to you, when it comes to income protection and critical illness, do think about actually what you need, as well as obviously what your loved ones need. Life cover obviously is absolutely about family protection because you won't be here. You know, it will be the money that needs to go to your loved ones left behind. And when it comes to life cover as well, especially for those of you that have already got it in place, there's something called a trust. So if you've got life cover, please put the policy in trust. What does that mean? That means that actually that money will go to the people that you want it to go to. So for those of you that aren't married, it's really, really important. For those of you that have got blended families or extended family that's quite complicated, definitely put your policy in trust. One, because it can actually avoid IHT. It can speed up the process. Probate delays are absolutely enormous at the moment. They're getting worse and worse and worse. And trust can actually make sure that the money gets paid out faster by the insurance company because it doesn't have to go through probate. And as I said, it makes sure that the money goes to who it needs to go to. If you have already done a policy in trust, wonderful, but just make sure that you review it. And that's my other message as well. For those of you that have got policies already, please review your cover. Certainly if you took it quite a few years ago. One, because your own circumstances have changed. Has your job changed? Your income, children's situation? Have you got divorced? Have you got married, etc., etc.? But then also the market has changed as well. Products have improved. So it could be that you could secure better cover, but also the underwriting process. So the way that an insurance company would actually assess your application has improved too in many cases. So it could be that you had a health issue a few years ago, and it might be that the way that they underwrote you meant that your premium had gone up to cover that additional risk. It may be that now your health situation is better. So the insurance companies would see you as a lower risk, which actually could save you money. But also it could be that actually during, you know, as underwriting philosophies have changed, could be that actually now they could offer better terms because just the way they approach that medical condition could actually be better. So, you know, go back to your advisor, go to speak to Ben or another advisor and just find out what actually is going to be the best option for you. But definitely do review your cover. So if you're going to be taking out cover as a result of this webinar, brilliant. But just make sure that every year, 2 years, 3 years, you actually think about, you know, contacting the advisor back, speaking to them just to see if there's anything that actually is on the market that could be better for you. And then employee benefits. You know, you might have them as an employed person. So as I said, speak to your HR team, find out exactly what you've got, and then you can then dovetail your own protection solutions. One little word of warning about employee benefits. They are really great to have, but you are not in control of them. So you might choose to be pure control over your own personal protection, because benefits can be lost. If you are planning, for example, to become self-employed in the future, you will leave that employed situation and you will obviously lose your benefits, or you might get made redundant. I was actually made redundant after having cancer, so I lost my employee benefits. Thankfully, I have my own personal protection. So whilst you need to consider, do you really want to be doubling up and paying for something that you might not necessarily need? But it does mean that you're in full control. So it's just something, again, to speak through to your advisor about. But do find out what employee benefits you've got, because it could be that you've actually got some really great ones in place. But those of you that are business owners, you might want to put some in place. And actually, group schemes for employees can actually start from as little as 2 people. So even if you're only a small firm, you can still actually take out an employee benefit scheme for you and your employees. And it could be a really good thing in terms of actually retention for your staff. Next slide, and I'll be as quick as I possibly can. So also just wanted to show that actually with these insurance policies, it's not just a case of paying premiums, hoping that nothing bad's going to happen and you don't get anything back from them. Because actually in recent years, there's been a huge amount of work by insurers to make sure that you as the consumer get more value for money out of them. So again, look at what you've got in place, because actually there could be a ton of stuff that you could be utilising that you're not even aware of. So for example, we all know how difficult it can be to get a GP appointment at the moment through the NHS. Well, actually a lot of insurers now offer 24/7 virtual GP appointments. So there's no need to be sitting on hold at 8:30 in the morning, number 76 in the queue, and you're never going to get an appointment. You can literally call up and they can, give you medical advice, even do prescriptions for you. That's a massive, massive, massive benefit. So again, if you've got a policy in place, you could be utilising that. If you haven't got a policy in place, but you take one, you get access to these things. And as you can see from that list, there's lots of other things that you can be accessing as well, such as physiotherapy, mental health support, health MOTs. I've got a health MOT, and annually I get a free health MOT. That's hugely beneficial. So, there's lots of things that you could be accessing. So do check out what you've got, and certainly find out what you get access to if you're going to be buying anything new in the future. And next slide, please. So takeaways. First thing is, as I said, cheapest is not always best. Think about what car you like, or the holidays or hotels you like to stay in. Cheapest is not necessarily always best. Focus on best value. Loads of options. That's why an advisor will be able to support you, and really just make sure that you're talking to your advisor about all the situations so that they can really help you make the very best decision. But ultimately, hopefully this will help you think about, what cover you might have in place already, what cover you might need going forward. But genuinely, the last thing I would ever want is for you to be sitting, or a loved one to be sitting on a sofa like I was in that situation, not being able to say you're not worried about money at a time when you really, really, really don't need to be worrying about money. So hopefully that has really helped, just to kind of shine a light on protection insurance and why it should be something that perhaps you should be looking into.
Thank you so much, Emma. And just to wrap up our session today, we have just touched on throughout the session about the importance of having an advisor. From my own experience, even we got my mum an advisor after my dad passed away to help with my dad's life insurance, and she just wanted that to be sitting in a cash account, not doing anything. And having worked in financial services, I just knew that probably wasn't the best idea. So I've seen firsthand the positive effects of having a financial advisor to guide you, and it just really alleviates not only stress on yourself, but also stress on your family, and it is really a weight off your mind. So as we'd mentioned before as well, there are going to be one-to-one sessions running next week with Ben. They are free and no obligation, but if you would like to book in, you can drop me an email. And here are some of the advantages, obviously, of having an advisor. We've gone through it in this webinar as well. But if you would just like to get some clarity on a specific problem, or you just want to get a little MOT and an idea of where to go next post this webinar, do book in with ourselves, and we can get you a time to chat with Ben, who can give you a bit more of a specific advice. So there's a little bit more about what an advisor can do, and also some of our testimonials as well. As I said, we are obviously Jackson Hodge Wealth, and we are wealth advisors on Vouched For. We are very highly recommended. Here are some of our client testimonials as well, so you can see for yourself what we are like. Equally, you are very much free to go and do your research. The important thing about this webinar is that you have some takeaways, and that you feel a bit more positive and empowered about what your next financial decisions might be. So yeah, Ben has given a great deal of advice to a lot of different clients, and personally, I speak to a lot of clients in Jackson Hodge who are very happy with our advice and have never complained as yet. So yeah, that's on our side. That's what we're about. Here's some references as well. And here is a little QR code. So if you would like to book in, you can scan that. Or if you would like to email me, I'm Catherine, just to remind you, and that's my email address down there. So yeah, just email me and I will do my very best to book you in. And also for anybody on the catch up as well, this goes for you too. You can email me at any time. Even if this webinar has just raised questions for you in general and you just had any feedback, drop us an email and we're all ears. And same with Emma, I'm sure as well. She's also very open to chatting and feedback also. Thank you so much for joining us. And I also have seen in the Q&A question box that you've all asked really great questions. I know Tyron's been typing as well furiously throughout the session, so hopefully some of those are answered. Just to kick us off, I know we're running out of time, so I'll just ask a couple. Student loan wise, Ben, is it worth paying off? I graduated before 2012 when I think the rules and interest rates changed. What do you think?
Great question. I would say that I'm very cautious about answering questions like that in a vacuum. I'd be very happy to sit down and have a chat with you about your broader situation. But I wouldn't want to sort of just give advice on purely based on a single question like that, because part of my role is to have an understanding of your overall situation and work out whether it makes sense for you to do that or whether there's potentially better options available. So I'm sorry, that's not directly answering the question. I guess what I'm saying is very happy to have a chat about your situation and whether or not that would make sense to do.
Mm-hmm. Yeah, I guess it is it's hard to give a one size fits all answer in these circumstances. So yeah, we will try our best, but it's so important to kind of understand a little bit about you as well. Emma, I can see you're typing, but with insurances, I would love to have all of these insurances in place, but I'm worried about costs. I know you covered a little bit about best value rather than, going for the cheapest. Can you talk a little bit more about that?
Yeah, just quick. Yeah, so sorry, I was just typing because I was conscious of time.
I know I can. Yeah.
What I was going to say. No, that's fine. That's fine. So, as I said, I really would prioritize income protection first. You are significantly more likely to be off work for more than 2 months through illness or injury than you are, for example, to die before retirement. So prioritize that one first. And there are budget options, so you can limit the benefit pay periods and the amount of money that actually gets paid out. So speak to Ben, get him to run some quotes for you. So look at that one first, and then from there you can then decide what your affordability is on that and whether there's any other money to be able to try and buy some other insurances, but certainly have a look at income protection first.
Great, thank you. And also, Emma, there was a lot of praise in the chat box for you raising awareness about breast cancer as well, which was great. And one more question. Sorry, we've kind of run out of time. But a question around, I'm 35 and I've not really thought about retirement. What steps can I fast track my journey? This is one of the most common ones we get in terms of where do I start? Can you both kind of shed a light a little bit on what's the first step in all of this?
I would say the first step is speaking to an advisor. It's never too late to start. 35 is certainly not too late to start having a think about what you should be doing in terms of planning for retirement. So please don't be worried that you're somehow already up against it. All it means is the earlier you start, the easier it becomes, because you're spreading essentially the investment costs, I guess, over a longer period. So yeah, the first step, which is normally always the most difficult one, is actually just deciding to do about it, and then getting in touch with an advisor and having a chat. Even if you don't take any action on it, at least, again, as Emma was saying, with some of the protection side of things, at least you're then in an informed position and able to make a decision based on that. So So I would say definitely not too late. Absolutely happy again to have a conversation to see what we might be able to do in your situation. And yeah, feel free to get in touch from my perspective.
Thank you. Emma, do you have anything to add?
No, I think, as I said, it's really about getting that advice, being in that informed position, and then just, and the earlier you do it, the best chance you've got of securing, because actually when it comes to insurance, the younger you are, the cheaper it's going to be for you. So the longer you leave it, the more expensive those quotes are going to get. I always just wanted to very quickly pick up on the point about the lady who's currently expecting. So congratulations. But in terms of preparing, when it comes to income protection, there are policies that will still pay out even if you're not in a position where you're currently working at that point. So if you are taking out an income protection policy, for those of you that might be taking career break in future because of family commitments, then make sure that you've got a policy that covers house persons cover. Ignore the terminology of house persons, but effectively, there are some policies that will only pay out if you are not able to work. Some of those policies, though, will be able to pay out if you're not able to do the duties around the home, such as childcare, such as all the other things that you will be doing as a busy mum. And that's really important, because actually, if you're not able to do those duties, it can be incredibly costly to pay for somebody else to do it. And that's what that policy will help you do. So house persons cover, for those of you that might take a career break, is something to look out for.
Brilliant. Thank you. We have so many brilliant questions. I know some of you, all of them have been either answered by ourselves or Tyron. So I hope you got the answer and the information that you needed. And thank you so much for sticking with us. And yeah, any questions or any feedback, or yeah, as we'd said, if you'd like to book a one-to-one, just get in touch. Thank you. And we hope this has been useful.
Thank you very much.
Thank you. Bye-bye.